What do you make of the old adage, as so goes January, so goes the rest of the year?
I hope it's true. Yeah, I'd like to believe that's true. Well, we'll find out. I think you hit on an important point. The Fed was certainly the elephant in the room, and it can make or break a year for markets. And I think we can look back now, and safely say that was a policy mistake. And they know it was a policy mistake because they've actually done a 180-degree reversal and have kind of walked back a lot of the harsh rhetoric. We're hearing terms like patient, and markets have liked that. And I think what it did last year was it really took a pro-growth agenda, something like a tax cut, and actually turned it into a liability because the Fed was acting from a mandate that the United States just couldn't do anything better than 2% sustainably. So every time they saw that, they saw a hot GDP number, they slammed on the brakes and stocks paid the price.
And so if you think that they made the policy mistake last year, I assume that means you believe they're on the right track.
I think they are on the right track. I don't think they can ignore the balance sheet. I think that's really something they need to focus on. Maybe 50 billion isn't the number, maybe even 35, but we have to do it. Because even if we bring the balance sheet down $1.5 trillion, that'll only get us to 2010 levels, and that's 2 times where we were in 2007. So I don't want to see them walk away from that. It has to be addressed.
Fair enough. The trade and what's going on with China is also another big elephant in the room, and a factor that markets certainly pay attention to. We at least got some commentary out of President Trump yesterday. But really no super forward progress. I wouldn't say we've nailed anything down.
It's a tough negotiation. And look, both sides want a deal. The president certainly needs one politically. The economy needs it. Certainly China needs it. We just saw a manufacturing number that was soft again. They're in contraction at this point. But I think it's important for the viewers to understand that, we're not negotiating with a partner or even a competitor. This is an adversary in every sense of the word, whether it's trade, economically, foreign policy, even militarily. This is the new Russia. We're going to be going up against these guys for a long time. And even after we get a deal, they're going to cheat. And we're going to have to come back to the table and do this all over again.
So then what does that mean? If you're an investor, how do you position yourself if ultimately we get a deal, but what does the deal really mean if you're working with an adversary?
It's not all in, all out. You're going to have to pick and choose your spots in there. Look, it's a big part of the economy, and it's certainly a lot bigger for them because the numbers just simply don't add up for them. It's much more important for China than it is for the United States. The one area that I'm concerned about, the president cannot cross the line on intellectual property. He's got to dig in there, even if it means pain for us here. That's an area we just can't cross there. The forced transfer of intellectual property, that's the crown jewels. We can't give that away.
But China certainly probably doesn't want to budge on that one either. I mean, isn't that the biggest sticking point? And that's what we went after in the first place?
Yeah, but President Xi understands something, and this is where he has an advantage, is he understands that here in the United States, unfortunately, our politicians are forced to think in terms of an election cycle. They think in terms of decades. And they've been playing that card for the last 30 years, and they've known that politicians would defend the status quo because nobody wanted to upset the apple cart. I think this president's a little different. I think, he's got some resolve here on this. I don't think he's going to cross the line.
What about earnings season so far? We've heard from a lot of players. We still got a number of big ones today. Yeah. And we've got Chevron, Exxon, so some oil names that are really important for us.
It's been kind of mixed. In some ways, we stepped over a lower bar. Maybe my biggest concern on the market this year is that starting in October, we started to see estimate revisions start to roll over. And in the end, that's what stocks will follow. Back then, in October, I think we were looking at $176 in earnings for the S&P 500. We're at about $170 right now. That's not the end of the world. It's not terrible, but it's something we obviously have to watch. Right now, I'm running a barbell approach, and I've got 2 quant models, one tilted towards value with high free cash flow names. That would certainly include banks. And the other side is, high estimate revision names, and that brings in a lot of growth stocks. And that would certainly mean names like a Workday, but unfortunately, even a name like Amazon is in our portfolio. So we'll take a hit there.